Hello, and thank you for attending our presentation today, Nanny Taxes 2026, Handling Your Client's Household Employment. My name is Trevor Sparks with GTM Payroll, and we appreciate the time you're able to spend with us today. A couple of housekeeping notes before we get started. If you have any questions, please use the questions functionality in the presentation console to submit them. We'll answer as many questions as we can during the presentation. If we don't get to your questions, we'll follow up with you within the next day. And you'll receive an email after the presentation with a link to download the slides and a video recording. During today's presentation, we'll ask you 4 questions. You must answer at least 3 questions to receive CPE credit. As a reminder, this course is 1 CPE credit hour. If you successfully complete the course, we'll email you the certificate of completion within 5 business days. Here's an overview of what we'll go over today. We'll discuss the basics of when someone is the employer, what happens as an employer, what obligations the employee has, what risks the employer has, what insurance is required, what's been happening with household employment and what's new this year, including paid leave laws, rising minimum wage rates, and labor compliance regulations. And also how to convey the importance of compliance to your client when saying it's the law just isn't enough. At the end of this presentation, you'll understand your client's household employment tax responsibilities and how to manage them, new labor laws that are impacting household employment, what's new this year and next in household employment tax compliance, and how to explain the benefits of compliance to your clients, as well as the costly downside if they're caught not following the law. And at this point, I'd like to turn it over to our presenter today, Mike Truicolo. Mike?
Thanks, Trevor. So before we get into what's new, I just want to take a step back and look at the basics of household employment, starting with who is a household employer and who are domestic employees. For the most part, it's going to be a family hiring a nanny to look after their children in the family's home. But we're also seeing more and more senior caregivers hired to help elderly loved ones age in place, as well as nanny shares, where one nanny cares for the children of multiple families in one of the family's homes. They've grown in popularity as an alternative to daycare centers. We've come a long way since 1993, when President Clinton's nominee for Attorney General Zoe Barrett was removed from consideration for the job because she and her husband broke the law by employing 2 illegal aliens to nanny and chauffeur their child and failed to pay employment taxes. That prompted Congress to change the way household employment taxes are filed and to create the Schedule H, which shifted nanny taxes onto Form 1040. So we typically think of a household employee as a nanny, but anybody who works in someone else's home can be considered an employee. As we mentioned, senior care is a growing workforce. If your client privately hires a senior caregiver, either for themselves or an elderly loved one like a parent, instead of going through a home health care agency, that worker could be considered an employee of the senior or the family. Another area you may not think of is seasonal or temporary childcare. A babysitter with regular hours, a nanny hired just for the summer, or an after-school nanny can easily earn enough for household employment taxes to kick in. Other household employees may include personal assistants, housekeepers, chefs, chauffeurs, and any other estate staff, as well as nanny shares. When a family hires a nanny, it's straightforward who the employer is, but I just wanted to point out that there are a couple of additional wrinkles when hiring senior care. Your clients have a few options for finding senior care. How they bring the in-home caregiver on board will determine whether they are now employers. A home health care agency will employ the caregiver to work in the senior's home, pay the employee, file taxes, and comply with tax, wage, and labor laws. In this scenario, the agency controls the job duties of the employee. The agency will select the caregiver and send them to the senior's home. However, the senior may not always get the same caregiver. The agency is the caregiver's employer, so they control the employment. A referral or placement agency that recruits the senior care worker on behalf of the family. They can charge a fee for this service and then hand over control of employment to the family, who is then responsible for payroll, taxes, insurance, and compliance. The caregiver is an employee of the senior or their family in this scenario, and this is similar to a family hiring a nanny through a nanny agency. By doing it themselves, a family finds, recruits, and hires the senior care worker without the assistance of an agency. The family will also handle payroll, taxes, insurance, and compliance. So in this scenario, the caregiver is an employee of that senior or their family. A family may try to avoid household employment taxes by classifying their worker as an independent contractor. That way, they can give them a 1099 at the end of the year, and the employee pays the entire tax obligation. An independent contractor pays both the employer and employee FICA tax obligation, which is 15.3% of cash wages. And the family also avoids unemployment taxes and other responsibilities, such as workers' compensation insurance. However, the IRS almost always classifies household workers as employees and not independent contractors. So that's not going to work. So here's why. It comes down to a matter of control. A family sets their employee schedule, tells the employee how to do their job, and the employee uses the family's tools and equipment. For example, a family with a nanny says your work hours are Monday through Friday, 8 a.m. to 6 p.m. The baby takes a nap at this time and is fed at these times. The nanny uses the family stroller for walks and their kitchen to prepare food. A nanny is not going to determine when they'll work, and they're not going to make up the baby's sleeping and eating schedule. So the family is in control of the employment, and the nanny is their employee. If there's ever any doubt, you can always file a Form SS-8 with the IRS and have the IRS decide on the worker status. Just understand that employee misclassification is considered felony tax evasion. All right, Trevor, I will turn it to you for our first poll question.
Okay, thanks, Mike. The first poll question is on everyone's screen. Which of the following affects whether a domestic worker is classified as an employee or an independent contractor? So these questions, just answer right there on your screen, A, B, C, or D. As a reminder, these are the poll questions we'll ask you throughout the presentation. There'll be 4 of them. You'll need to answer 3 in order to qualify for CPE credit. You don't have to be correct in your answer. You just have to answer them, and they'll be related to the topics we're covering. If you have questions about the material we're presenting, please submit those in the presentation console. We'll get to as many questions as we can by the end of our time here together. If we don't get to your question, we'll certainly follow up with you within the next day and get you some answers. I know tax season is coming up and probably a lot of questions about household employment. So that's what we're here for today, to help guide you through that piece of your work. So it looks like we have just about everybody in, and the answer here is D. All of the above, all of those will factor into classifying a household employee as an employee rather than an independent contractor. Okay, Mike, turning it back to you.
All right. So one of the first steps to understanding nanny taxes is determining whether the employee's wages have met or exceeded the employment coverage threshold for domestic workers. This is commonly referred to as the nanny tax threshold. So there's no coverage threshold for most industries, so every dollar of wages is covered and taxable. Household employment is one of the industries with an employment coverage threshold. The Social Security Administration sets this amount every year, and for household employees, it changes with the National Average Wage Index. The threshold for wages earned this year is 2,800. Next year's threshold will be 3,000 even, and when you're filing for the upcoming tax season, be sure to use the 2025 threshold for this. So you can see how easy for even a temporary or seasonal worker, such as a summer or an after-school nanny, to exceed that threshold and trigger nanny tax compliance. If a family goes over that wage threshold, they'll need to withhold and pay Social Security and Medicare taxes, which are commonly called FICA taxes. That's a total of 15.3% of cash wages, which is split evenly between the employer and the employee, with each of them contributing 7.65%. Employers can choose to pay their employee's share and not withhold it. Keep in mind that the taxes paid to cover an employee's share of FICA must be included in their wages for income tax purposes. They aren't counted as Social Security and Medicare wages or as federal unemployment wages. You can report the Social Security and Medicare taxes paid in boxes 4 and 6 of the employee's W-2 form and add the taxes to the employee's wages reported in box 1 of the W-2. Be sure not to count wages that are paid to a spouse, a child under the age of 21, a parent, or any employee that's under the age of 18. For unemployment taxes, if cash wages to an employee is $1,000 or more in any calendar quarter, then the employer pays federal unemployment tax. That's 6% of cash wages on the first $7,000 of wages. An employer may also owe state unemployment taxes. They may be able to take a credit against their federal unemployment tax if they pay state unemployment. It could be as much as 5.4%, which will really reduce the amount owed for federal unemployment. For unemployment taxes, the exclusions are spouses, children under the age of 21, or parents. So just to review a couple of key points, household employment tax responsibilities kick in when the $2,800 in cash wages threshold for 2025 is met, or $3,000 for 2026. The family will pay 7.65% of their employees' pay in FICA taxes, and they will also pay federal and state unemployment taxes if applicable. For the employee, they also owe 7.65% of their pay. This is required to be withheld and remitted by the family. Again, the family can choose to pay this on their employee's behalf instead. Either way, the employer is responsible for remitting the employee's portion of FICA taxes. Federal income tax does not need to be withheld, only if the family wants to. However, it's a good idea to withhold so the employee is not stuck with their entire income tax bill at the end of the year. If a family decides to withhold income tax, they need to provide their employee with a Form W-4 and a state withholding form. That will determine how much to withhold from the employee's pay for income taxes. State and local taxes, if applicable, will obviously vary depending on where the employee lives. So we know what is owed, but how are these taxes remitted? So you have two ways that you can go about this. The first way is probably the best way to do it. Remit household employment taxes quarterly using Form 1040 ES, then detail the amounts paid on the Schedule H. If your client prefers, they could increase withholdings from their own pay to anticipate this increase to cover their household employment taxes. You should do one or the other. If their nanny tax obligation is large enough, your client may wind up owing taxes when they file and possibly be subjected to an estimated tax penalty and interest for underpaying taxes during the year. Trevor, I will turn it to you for our second poll question.
Okay, thanks, Mike. Our second poll question is up. An employer can choose to pay the employee Social Security and Medicare tax responsibility. So answer right there on your screen, true or false. Any other questions about the material we're covering, just submit those to the console and we'll answer questions at the end of our formal presentation. You will receive an email a little later today with a link to download this presentation as a PDF, so you have that. And then also there will be a video recording, a YouTube link in that email as well. So to rewatch any parts, the whole thing, or if you want to share with colleagues. So that's what we have going on today. And if you answer 3 of these poll questions, you will be eligible for CPE credit, and those certificates will be emailed out within the next few days. All right, looks like we have just about everybody in. And the answer here is true. The employer can choose to pay the employee's FICA taxes. All right. All right, Mike, turning it back to you.
All right, so let's talk paperwork. So here are some of the forms that are needed as a household employer. The SS4 to apply for an EIN, which can be done online as well. The family will also need to be set up as an employer with their state and file a new hire report. They'll also need to obtain a Form I-9 from their employee, which we'll get into more in a moment. If they decide to withhold income taxes, they'll also need to obtain a Form W-4 and a state withholding form from their employees. So a little bit more about the I-9 form. Families with household help must collect the I-9 from their workers at the start of their employment. This is something we've all filled out when we've started a new job, and it's no different for nannies, housekeepers, or senior caregivers. As a reminder, the I-9 confirms a worker's identity and authorization to work in the U.S. They can submit a document from List A to prove their identity and employment authorization, or a combination of documents from Lists B and C. Form I-9 must be signed no later than the first day of employment, and the documents must be presented within 3 business days from the start of employment. A family must inspect the documents, make copies, and return the originals to their employee. The documents must reasonably appear to be genuine and relate to the employee. Copies of the documents are kept in the employee's personnel file with the I-9, and they are not returned to any government agency. Employers must retain the I-9 for either 3 years after the date of hire, for 1 year after employment is terminated, whichever is later. The I-9 can be completed electronically to help reduce errors, and it's available on the U.S. Citizenship and Immigration Services website at uscis.gov. At year end, the employee needs to receive their W-2 by January 31st. Since that falls on a Saturday in 2026, they'll actually be due on Monday, February 2nd. Also, Form W-3 and Copy A of Form W-2 must be submitted to the Social Security Administration by that same date. And again, next year it'll be on Monday, February 2nd. And then the Schedule H will be filed with the employer's personal tax return. What we've covered so far is basic tax withholding responsibilities. So now we'll get into some of the labor, tax, and payroll nuances surrounding household employment. Some of these are state specific, like a domestic workers' bill of rights. There are also rules around overtime pay, live-in workers, sleep time, and companionship care. And in a growing trend, many states and cities have paid leave requirements that are impacting household employers. So what is a domestic workers' bill of rights? These laws bundle domestic worker protections, which could include minimum wage, overtime pay, paid time off, days of rest, and more. In New York, for example, household employers must give 1 day of rest for every 7 days and provide written policies on sick leave, vacation and work hours, 3 paid days off after a year of work, and they must pay on a weekly basis, and they'll need to provide a pay stub, even if the employee is paid electronically or by direct deposit. Massachusetts is similar. There are protections for a mandated amount of rest time depending on hours worked, written work agreements, and more. So if you have clients with household employees in any of the states or cities with domestic worker protections, you'll want to familiarize yourself with those obligations. The first Domestic Workers Bill of Rights took effect in New York in 2010. Since then, several other states and the cities of Chicago, Philadelphia, Seattle, and Washington, D.C. have enacted similar laws to grant basic labor protections to household employees. As a heads up, domestic worker protection legislation is working its way through the state legislature in Washington, so we're keeping an eye on that. You'll hear us say this frequently during the presentation, but noncompliance is costly. Here's just one example from New York. If your client violates the state Domestic Workers Bill of Rights, which requires weekly pay for household employees, they could be sued for up to 300% of delayed wages, plus attorney fees and interest. And again, it's important to review the domestic worker protections in your state and city. The FLSA, which stands for the Fair Labor Standards Act, includes household employees. Domestic workers must be paid at least the applicable minimum wage rate. The federal minimum wage is $7.25 an hour, and that hasn't changed for quite some time. However, many states, counties, and cities have enacted higher minimum wage rates than the federal rate. In California, for example, the minimum wage is $16.50 an hour, which supersedes the federal rate and becomes the applicable rate. However, dozens of cities in California have higher rates than the state rate. Los Angeles is now $17.87 an hour, and San Francisco is $19.18 an hour. So those local rates apply. And just to make it even trickier, many states have built-in increases to their minimum wage rates. You'll need to pay attention to this if your client is paying their employee minimum wage or close to it, as that hourly rate may quickly violate wage law. According to the FLSA, household employees are non-exempt workers. That means they must be paid hourly rather than a fixed salary. This also means household employees get time and a half in overtime hours for anything worked over 40 hours in a 7-day work week. Live-in employees and caregivers who meet the companionship care definition may be exempt from overtime, which we'll get into more in a moment. California is a little bit different. Time and a half kicks in after 8 hours a day, 40 hours a week, and the first 8 hours worked on the 7th consecutive day of work in a work week. Your clients with household help should maintain records of hours worked and pay to ensure they're meeting minimum wage and overtime rules. This is where many household employers end up getting in trouble. They don't track hours or pay and wind up getting sued by a disgruntled employee who seeks back wages because they weren't paid properly. Later on in this presentation, we'll get into the new no tax on overtime. Live-in employees. You'll see this with nannies or seniors who need around-the-clock care. Up to 8 hours of sleep time can be unpaid if certain criteria are met, and 5 hours of continuous sleep is a big one. If a live-in nanny is expected to be on call during the night and their sleep time is interrupted to care for a child, even for a few minutes, and they don't get at least 5 hours of uninterrupted sleep, then the entire 8 hours of sleep time is now paid. The exception to this is California, which doesn't allow sleep time to be unpaid. As for overtime, federal law exempts live-in employees from overtime pay. However, some states, such as New York, have their own overtime requirements for live-in employees, which will supersede federal law. In Minnesota, overtime for live-in employees starts at 48 hours. Oregon, like New York, is at 44 hours. In Hawaii and Maryland, live-in employees need to be paid overtime for hours over 40, so they're not excluded from the overtime laws in those states. Companionship care. This is a key consideration in senior care. If a caregiver falls into the companionship care exemption, they do not need to be paid overtime for hours worked over 40 in a work week. If they don't have the exemption, then they must be paid the overtime. Work is defined as things necessary to care for an elderly patient. Bathing or dressing the patient, cleaning, and cooking are some of those activities. Only 20% of a caregiver's work time can be spent doing these sorts of activities in order to qualify for the exemption. That means the rest of their time is spent with fellowship and protection. They could be watching TV, doing puzzles, playing cards, or doing whatever it is that is not necessary for the care of the elderly patient. It's also important to know that the exemption doesn't apply to caregivers that are hired through a third party. So if the family thinks they can take advantage of the companionship care exemption, hiring privately and not going through a third party could be a big financial benefit. There's a growing trend for paid family and medical leave at the state level, and many of these programs include household employers. There are more than a dozen states with laws requiring paid leave, and we've listed several of them here. California, Colorado, Connecticut, Illinois, Massachusetts, Michigan, Minnesota, New Jersey, New York, Oregon, and Washington State are all active, meaning household employees, if eligible, can take leave for qualified reasons. A couple to keep in mind if you have clients in these states. Contributions to Maryland family and medical leave have been delayed. Payroll deductions will now start in January of 2027, with benefits available the following year. In Minnesota, contributions to its paid family and medical leave program start in January of 2026. However, employers are required to submit quarterly wage reports to the state for PFML purposes. That started on October 31st. Employers were also required to provide written notice to their employees by December 1st. Localities such as New York City, Chicago, Pittsburgh, and Washington, D.C. also have paid leave requirements. And on January 1st, Pittsburgh's Paid Sick Days Act will increase the number of paid leave hours available to household employees. That'll go from 24 hours to 48 hours a year. Paid leave laws often apply to all employers, even those with just one employee, such as a family with a senior caregiver or a nanny. These programs may require a small employee contribution through a payroll deduction, or your client can cover that contribution for their employee. So it's important to review any paid leave laws in your state and determine whether they apply to household employers. If they do, you'll need to follow the rules on contributions if required. So we mentioned earlier that families may try to classify their employees as independent contractors to avoid their tax obligations. Another way to avoid their responsibilities is to put a nanny or senior caregiver on company payroll, and that won't fly with the IRS either. It's considered an illegal tax deduction because all employees on a business payroll must directly contribute to the business's success. And of course, there is an exception. A sole proprietor of a business or farm with household employees can report their household payroll taxes on their company's Form 941 or 943 for farmers for ease of filing. That doesn't mean that they can just put their household worker on their business payroll. It just means that they can report the taxes on the Form 941 or 943. Even with this exception, and to keep it simple, it may be best to file household payroll taxes separate from your business-related taxes. File Schedule H for household and Form 941 for business, or Form 943 if that business is a farm. Outside of that one exception, don't use the Form 941. Using a 941 and not the Schedule H is a common way that accountants may handle household payroll and make mistakes when reporting household employment taxes. This misstep can make more work for you, increase the risk of penalties, cause dual reporting to the IRS, and create other accounting issues. The Schedule H was created specifically for household employers to report wages paid to an employee during that year. It's an annual filing that's prepared with your client's personal income tax return. Form 941, however, is filed every quarter, even if your client didn't pay an employee during that period. And if you fail to file a Form 941, even with no payroll to report, your client will incur penalties. You should keep copies of the Schedule H and other employment tax forms filed, as well as Forms W-2, W-3, and W-4. For unemployment tax purposes, you should also retain the total amount of employee compensation, amount subject to unemployment tax, and state unemployment contributions. Keep your payroll and tax records for at least 4 years after the due date of the return on which you report the taxes, or the date that the taxes were paid, whichever one comes later. Unemployment tax records should also be retained for 4 years after their due date or the date the unemployment tax was paid, again, whichever is later. Most states have a 2-year statute of limitations on lawsuits filed by former employees, so be sure to keep documentation for at least that time period. And for auditing purposes, you may want to maintain tax and payroll records for up to 7 years. In any case, it's always a good idea to maintain employee tax and payroll records for longer than you think you may need them. So those are the basics when it comes to tax, wage, and labor laws for household employment. I also want to highlight liability insurance, as this can be one of the costliest mistakes a household employer can make and an easy way for a family to get caught if they're not paying their employee on the books. So you never know when an injury might occur, whether it's around the house, driving the kids in the car, or walking the dog. Unforeseen risks are always in play. Household employers in many states are required to carry workers' compensation insurance for employees who get hurt or sick on the job. It'll help pay for a worker's medical expenses and lost wages. Without the required coverage, a family could face thousands of dollars in fines and penalties, as well as a possible lawsuit to recoup lost wages and pay for medical expenses. So even if workers' comp is not required, it may be wise to get voluntary coverage. So who benefits from workers' compensation? Both the employee and the employer are protected by this, and some of the employee's medical bills and lost wages will be covered, and the employers will be very likely to avoid a lawsuit. This kind of protection can easily be worth tens of thousands of dollars for your high net worth clients. A popular question we get here at GTM when the topic of workers' comp comes up: doesn't my homeowner's insurance cover this? The short answer to this is no. There is a difference between someone visiting your home and slipping or falling, or even a worker such as a plumber or an electrician getting injured while working in your home, versus having somebody employed in your home for 20, 30, 40, or even 50 hours a week. You should never assume that an employee is covered under homeowners insurance. The exceptions here are New Jersey and California. In New Jersey, you can add a rider for your workers' compensation to your homeowner's policy, which is substantially cheaper than a standalone policy. In California, it's actually required to have workers' compensation on your homeowner's policy if you have a household employee. This is what we mean by not having the required workers' comp is one of the costliest mistakes that a household employer can make. Fines can be as high as $5,000 for every 10 days of noncompliance, which is about $15,000 a month. It's not uncommon for fines to quickly reach tens of thousands of dollars. The GTM Insurance Agency, which is an affiliate of GTM Payroll, will receive calls when a family is looking to get coverage because they just got caught not having a policy or their employee got hurt. Once, a family came to us after getting a $120,000 fine for not having the required coverage in place. So again, looking at the workers' comp rules in your state is important. And we've listed the states where it's required for full-time, part-time, and full-time only workers. So how does somebody get caught? This happened in Connecticut to a family that was paying their nanny off the books. Their nanny fell down the stairs while carrying a baby, and the baby was okay, but the nanny injured her back. She went to the hospital, and the doctor asked, "How did this happen?" And the nanny responds, "Well, I was working." So it immediately becomes a workers' compensation case, even unintentionally. Due to this, the nanny missed several weeks of work, and during this time, she expected her medical bills to be paid and to receive her typical pay while she recovered. The family didn't want to pay her because they were already paying another caregiver to cover for this injured nanny. So a couple of things happen here. The family was exposed for paying their nanny illegally. And why? Because they didn't have workers' compensation. They dealt with back taxes owed, plus fines and penalties on those back taxes. And they dealt with fines for not having workers' compensation in place, which in Connecticut is $300 a day for every day without coverage. So you can see how quickly this adds up. On top of that, the family paid the employee's medical bills, lost wages, and a fill-in nanny, and they needed to find another employee as they had damaged the relationship with their original nanny. And Trevor, I will turn it to you for our third poll question.
Okay, thanks, Mike. Our next poll question should be up on everyone's screen. Workers' compensation insurance protects employers from which of the following risks? So answer right there on your screen, A, B, C, or D. This is the third poll question today. We have one more coming. If you answer 3 of these 4 poll questions, you're eligible for CPE credit, and those certificates will be emailed out to you within the next few days. We're coming close to the end of our formal presentation today, so if you have any questions, please put those in the webinar console. We'll get to as many questions as we can before the end of our time with you today. Michael's contact information will be available at the end as well, so if something comes up after the presentation today, you can certainly email or call him, and he'll be happy to help you. And if we don't get to your question today, we'll follow up as well. And look for an email later today that'll contain a link to download the slides as a PDF, as well as a link to a video recording. So look for that later today. With all that said, it looks like we have just about everybody in, and the answer here is both A and C. All right, Mike, I'm going to turn it back to you now.
Okay, so the One Big Beautiful Bill Act that was introduced, that introduced the no tax on overtime rule. So while it doesn't change how you or your clients run payroll, it directly affects an employer's federal income tax liability. Federal income tax will no longer apply to the overtime premium portion. That's the half of the time and a half of certain qualifying overtime wages. This change is retroactive to January 1st, 2025. To benefit from this deduction, the overtime must meet the requirements of the Fair Labor Standards Act. For household employment, this applies only to live-out employees, and the employee works over 40 hours in a 7-day work week. If an employee is paid if an employee is paid $20 an hour, their overtime rate is then $30 an hour. That extra $10 an hour is the overtime premium and is not subject to federal income tax. Remember, live-in employees are not required to be paid overtime under the FLSA. The state laws we discussed earlier regarding live-in employees and daily overtime don't apply here. It's just what's federally mandated by the FLSA. Also, double time, holiday pay premiums, or guaranteed overtime hours that are not directly tied to FLSA mandated hours don't apply. So while your client still must pay these amounts based on the state law or their employment agreement, the employee cannot claim the federal tax deduction on those premium payments. The employee can deduct up to $12,500 for individuals or $25,000 for joint filers. The deduction will be claimed when the employee files their personal tax return. This deduction does not impact Social Security, Medicare, or state income taxes. Those contributions remain exactly the same. The IRS recently provided penalty relief to employers for no tax on overtime due to not filing correct information returns or providing correct payee statements to employees. That means employers will not face penalties for failing to separately provide the total amount of qualified overtime compensation. The relief is limited to returns and statements filed and provided for tax year 2025. The IRS also announced that Form W-2 for the 2025 tax year will not be updated to account for the One Big Beautiful Bill related changes. So the 2025 tax year will be treated as a transition period for the IRS enforcement and administration of the new information and reporting requirements for qualified overtime compensation. The IRS is encouraging employers to provide employees with a separate accounting of overtime compensation so employees have the information necessary to claim the deduction for qualified overtime compensation for the 2025 tax year. Employers can make the information available to their employees through additional written statements or add qualified overtime compensation in box 14 of the employee's W-2 form. The tax reporting rule for mobile payments is now being phased in. Employees would have received 1099-K forms from this past tax season if last year's reporting criteria of $5,000 in transactions was met. The threshold will be lowered to $2,500 this year before reaching the statutory level in 2026. The reporting rule may change how your clients pay their nannies and babysitters. Payments for goods and services such as babysitting or childcare through third-party settlement organizations such as Venmo, PayPal, and Cash App were reported to the IRS if those transactions totaled $5,000 or more. The intent of the requirement is aimed at businesses that use these apps to get around banks and traditional forms of reporting income. The IRS wants to make more transactions reportable so that it's harder for businesses to underreport their taxable income. Unfortunately, with this, household employers are getting swept up in it as well. Families that employ full or part-time household help, such as nannies, in-home senior caregivers, and housekeepers may want to avoid using mobile payment platforms to pay their workers, as those workers will likely get a 1099-K from the IRS as well as a W-2 from their family, which can cause some confusion. Paying a date night or occasional babysitter through a mobile app may still be acceptable, but those sitters should know that their income will likely be reported to the IRS and should be reported on their personal tax return. It's always been a requirement to report income when net earnings from self-employment exceed $400. This new rule just broadens the reporting of tax information to the IRS. So remember, this is not a new tax, it's just a new reporting requirement. A seemingly easy way to circumvent the new rules may be to pay for a babysitter services in a personal transaction as if they were a family member or a friend. However, if you pay a babysitter on a regular basis, those consistent transactions will raise red flags with the payment platform and call into question whether those payments were truly made to a family member or a friend. In fact, PayPal, which also owns Venmo, says it will monitor accounts to ensure that personal payments are not being used for sales of goods or services. It's always best to pay a babysitter as a service transaction. A best practice would be to pay a full-time nanny or employee by direct deposit or check. So here are the contribution limits for certain employee benefits for the 2026 tax year. Contributions are made on a pre-tax basis, which can reduce the amount your client and employee owe in taxes. Plus, offering benefits is a great way for your client to retain top workers and attract the best candidates. Here are some of the key contribution limits relevant to household employment. I just want to highlight that the QSEHRA, which stands for the Qualified Small Employer Health Reimbursement Account, this can help an employee reduce their healthcare costs tax-free. It's for employers with less than 50 employees as long as they don't already offer a group health insurance plan. So this is perfect for families with household help. Employees are reimbursed for their health insurance coverage purchased on the individual market or through the healthcare exchange, and for out-of-pocket medical, dental, and vision expenses. These QSERAs are funded by the employer, and these contributions are not taxed for the employer or the employee. Reimbursements are also not taxed as long as the employee has a health plan that meets minimum essential coverage. For 2026, the maximum annual contribution for a dependent care FSA will increase to $7,500 per household, or $3,750 for those married filing separately. This change was part of that One Big Beautiful Bill Act, which provides a permanent but not inflation index increase to the contribution limit for the first time since 1986. A dependent care FSA, sometimes referred to as a dependent care assistance plan or DCAP, is a pre-tax benefit account offered by employers and used to pay for qualified out-of-pocket dependent care expenses such as a nanny's wages. By putting money into a dependent care FSA, your client will reduce their overall tax obligation as funds are withdrawn from their pay and placed into their account before taxes are deducted. It lowers their taxable income, both for income and FICA taxes, so your clients end up paying less in taxes. So as we've discussed, household employees must be paid the highest applicable minimum wage among federal, state, and local rates. State and local rates have been on the rise. Many states and cities are making annual incremental increases until they hit $15 an hour or more. So this is just a sampling of states and other jurisdictions that are popular for household employment and increase their minimum wage rates on January 1st. Some new and upcoming paid leave programs have requirements to be aware of. In Minnesota, the first quarterly wage detail reports were due on October 31st. These reports must detail the wages paid to employees between July 1st, 2025 and September 30th, 2025. This information is submitted using the existing state unemployment insurance system. The quarterly wage detail reports submitted for paid leave are identical to the wage detail reports employers currently submit for their unemployment insurance purposes. And then on January 1st, employers can begin deducting the employee share of paid leave. As mentioned earlier, Maryland has delayed the implementation of its family and medical leave insurance program. Payroll deductions for this won't begin until January of 2027, with benefits for employees starting no later than a year. A couple of significant changes to Pittsburgh's Paid Sick Days Act will affect household employers. Starting January 1st, the amount of paid leave available to employees doubles to 48 hours, and they will accrue paid leave at a faster rate. In Maine, withholdings for contributions started back in January, and quarterly wage reporting also started this year. Then, in May, employees can start taking leave. Retirement plan requirements are starting to take hold across the country as well. Most state laws likely won't apply to household employers because of the minimum number of employees required to qualify. However, California has now lowered the threshold for its retirement plan requirement to just one employee, down from 5. So your clients in California must enroll in CalSavers or sponsor a qualified retirement plan on their own and report that to the state. Maryland's law is new and starts with just one employee. However, your client must have been a household employer for at least 2 calendar years to qualify. Again, clients can enroll in the state program or sponsor a retirement plan of their own. Looking ahead to next year, Hawaii will require a retirement plan for all employers. So I'd like to wrap up with some of the benefits of being compliant. We've already talked about the first 3 benefits on this list. It's lowering your risk and avoiding trouble with the IRS, workers' compensation boards, and disgruntled employees. A client can also take advantage of those tax breaks, which may be more than their nanny tax obligation. For an employee, they'll have a legal employment record and verifiable income, which helps in getting a loan, a mortgage, or a line of credit. If a nanny wants to buy a home or a car, it's better that they're paid legally. They can also get unemployment benefits if they are let go through no fault of their own. They're also protected by workers' compensation if they're injured on the job and in states with disability insurance requirements. They're protected for injuries outside of work. With senior care, you can look to reduce costs through long-term care insurance and veterans benefits. To take advantage, you may need to provide payroll information and caregiver activity logs, so the caregiver needs to be paid legally. Your client may be able to deduct expenses they paid during the year for medical and dental care for themselves, their spouses, and their dependents. IRS Publication 502 has more details on this. With a medical care or healthcare FSA offered through your client's employer, they may be able to pay their elderly loved one's medical expenses that aren't covered by insurance. The senior must qualify as their dependent in this case. If the person receiving care lives with your client, is physically and mentally unable to care for themselves, and requires a caregiver to care for them so that your client can work, then your client may be able to pay off some of their senior's care expenses with a dependent care FSA offered through their employer. The senior may also be a qualifying individual under the Child and Dependent Care Tax Credit. The senior must be physically or mentally incapable of self-care, have lived with your client for more than half of the year, and be either their dependent or could have been their dependent under certain exceptions. These are potential options for your clients to reduce their tax obligation and reduce their costs as a household employer. And Trevor, I will turn it back to you for our final poll question.
Okay, thanks, Mike. Our final poll question is on the screen. What are the benefits of being compliant with domestic payroll laws and regulations? This is our final poll question. So we've offered 4 questions throughout the presentation today. You need to have answered 3 of them, and you will qualify for CPE credit, and those certificates will be emailed out to you within the next few days. We're just in the home stretch of our formal presentation, just a couple more things to cover, and then we'll get to your questions. I know we had a couple come in through the registration process, so we'll certainly get to those. If we don't get to your questions before the end of the hour, we'll certainly follow up with you in the next day or so and get you some answers to those questions. We'll also have Mike's contact information at the end of the presentation, so make note of that, and you'll be able to reach out to him if you have any questions after we're done today. So looks like we have everybody in, and the answer here is D, all of the above. All of those are benefits of being compliant. All right, Mike, turning it back to you.
Okay, so if you have a client with a household employee, these are the steps you or they will need to take to be compliant. They must file federal and state unemployment taxes every quarter and prepare W-2s, W-3s, and Schedule H at the end of each year. The last point here could be the most important. Tax, wage, and labor laws are constantly changing. We talked about paid leave laws, minimum wage rates, and domestic workers' protections, and more are coming. So it's important to monitor changes in the law that may impact your clients that have household help. So our biggest tip, don't procrastinate. We can't emphasize this enough. Household employment compliance is not something to handle at tax time. You have enough going on, and you don't need a client to tell you in January that they hired a nanny the previous year and haven't been withholding taxes. You'll need to track down hours and wage information to make sure minimum wage and overtime rules have been followed. That's the last thing you'll want to be doing during your busy time of year. So it's much better to get on top of this at the time of hire. Also, keep in mind workers' compensation needs to be in place before the employee starts work. And again, those fines are daily, so it's important to get them set up beforehand.
Sorry, Mike,
So
just
we
having a little bit of technical difficulty here. We're going to reshare the presentation just right now. Sorry about that. A little glitch in the system here. All
No
right.
worries.
Okay, I think we're back on track. Thanks.
Perfect. Thanks, Trevor. So on your screen here is a list of resources available, including publication 926, which is essentially the IRS Bible regarding household employment. So we've discussed using the form SS8 if you want the IRS to tell your client that their nanny is an employee and not an independent contractor. Form W4 is needed if your client will withhold income taxes from their employee's pay. And I'd like to thank everyone here for attending our presentation today, and I do hope you found it valuable. So we do have some time for a couple of questions now, but if anything comes up while you're handling nanny taxes or household payroll, please don't hesitate to contact us. We are more than happy to help. All right, Trevor, on to the questions.
All right, thanks, Mike. Our first question, this one came in through the registration process. Good one for this time of year. Can I prepare a client's return even if he refuses to prepare either Form 1099 or a W-2?
So you can do this, but it does open a can of worms. Issuing a 1099, it's a non-starter as a domestic employee receives a W-2. If you prepare your client's return and include a Schedule H, which reconciles the household employment taxes, then your client will get in trouble because no W-2 was issued to the employee. There will be no tax filings tied in, so the IRS and the state tax agency are going to be looking for returns, and that's where the headache begins. If you prepare your client's return and you don't include a Schedule H, then the client can get in trouble for not reporting those household employment taxes. They risk tax evasion if it's uncovered, including penalties and interest for not filing, as well as potential workers' comp penalties and unemployment wage fines for failure to report the income. So regardless, it's a no-win. The only way to do it right is to provide the employee with a W-2 and then file a Schedule H with your client's tax return. Also keep in mind, the employee can file their personal tax return and indicate that they did not get a W-2 from your client. As soon as that happens, your client will get a call from the IRS. And it's one of the most common ways we've seen household employers get caught not being in compliance.
All right, thanks, Mike. One way to do it, and that's just the right way. Get the W-2 and the Schedule H and be in compliance and safe. All right, our next question, again, related to upcoming tax season. How do you file Schedule H if all tax payments were made during the year?
Yeah, so we'll do just a quick recap of the Schedule H first. As we discussed, it's filed with the personal tax return, and it's where you report your client's household employment taxes to the IRS. On the Schedule H, you'll report the total amount owed in household employment taxes, and these will also include Social Security and Medicare, as well as federal unemployment and state unemployment. If you've remitted the household employment taxes for your client quarterly using the Form 1040 ES, you can enter those payments on Schedule 3 and on Form 1040. If a payroll service like GTM, let's say, is remitting the taxes on your client's behalf each quarter, you'll count those as estimated tax payments on Schedule 3. So again, it's a good idea to withhold taxes for each pay period and remit both the employer and employee tax amounts each quarter with the 1040 ES form. That way, your client isn't stuck with the entire tax obligation when they file their personal return. And since household employment taxes are added to your client's personal tax obligation, they have to pay an estimated tax underpayment penalty if they haven't been paying them throughout the year.
Okay, thanks, Mike. Another Schedule H related question. How do you report on Schedule H when your client has multiple household employees?
So you'll enter everything in aggregate. So for example, box 1A will ask for total cash wages that are subject to Social Security. The wages that you enter in that box are the total wages for all of your employees. So you'll only ever need to file one Schedule H, and that will cover all the employees you have on payroll. And you don't have to file a Schedule H for each individual employee that you have.
Okay. Our next question here, what are the potential penalties if a client is audited and they had a household employee who wasn't set up correctly as a W-2 employee?
So there can be fines at a state and federal level. A lot of these fines are left to the agency's discretion, so it's hard to pinpoint what exactly will be owed. There's also penalties and interest, which can be up to 15% of the back taxes that are owed. There's also a potential for workers' comp penalties if your client was required to have coverage, but they never obtained a policy, which, as we said, it can be up to $300 a day for every day they've gone without that coverage in place. So it can get costly to be caught out of compliance. If you do have a client in this type of situation, we can help to get them back on track and possibly avoid some major fines and penalties. Just give us a call and we'll be more than happy to see if we can help out.
All right, Mike's phone number and email are right there if you need any help getting some clients caught up. It's a popular service of ours this time of year where some household clients realize they haven't been paying correctly, or I'll get around to it, and it's December and it's time to get around to it. So certainly reach out to Mike on that one. We have time for one more question here. What about employees who do not have Social Security numbers or need to update their ITINs?
So an employee who has the ITIN and not a social security number, it can get you in a little bit of hot water. The ITIN is a tax processing number issued by the IRS to somebody who's required to have a tax identification number, but either they don't have a social or they're not eligible to have one. It doesn't serve any purpose other than federal tax reporting. Let's say a non-resident who is a college student or researcher may receive taxable payments such as fellowships, scholarships, or awards. They need to report those to the IRS even though they can't obtain a social security number. The I-10, it doesn't authorize somebody to work in the US or provide legal immigration status. Or it doesn't even prove the legal presence in the country. It just gives them a number in order to report these taxes. So in January, when filing the W-2 with the SSA, you may receive notices and fines for filing a W-2 that has no social security number attached to it. If your employee is authorized to work in the US, they should obtain a social security number as soon as possible, and they can apply online now. Then use that social security number on all tax documents going forward.
All right. Thank you, Mike. I believe that's all the questions we have right now. Just one little check here. Yep. Okay. I think we're caught up on the questions, but again, if something comes up after our time here, reach out to Mike. His phone and email are right there on the screen, and you'll also receive those in the email that will be sent to you later today. So that is all the time we have. Again, that email will be coming out later today. You'll receive a PDF copy of this presentation and a link to watch a recording. You're eligible for CPE credit if you participated in at least 3 of our poll questions, and you'll receive a certificate of completion by email within the next 5 business days. So again, if we can be of any assistance to you or your clients, please don't hesitate to reach out. We'll be more than happy to help. And once again, thanks for joining us today. Have a great rest of the day.